This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
You may recall that back in chapter 14, where we looked at CGT reliefs for individuals, that was a very long chapter indeed. There were so many reliefs available to individuals. You may recall such reliefs as entrepreneurs relief, gift relief, rollover relief, PPR, principal private residence relief. Well, be reassured now that when it comes to dealing with corporate tax and reliefs for capital gains, this is a very short chapter. There is only one relief that is available so far as corporate tax is concerned when it comes to capital gains. That's the one that you can see in front of you now on the screen, rollover relief. Rollover relief comes in two forms. We've got the rollover relief as we know it, where we reinvest in another qualifying business asset the sales proceeds from the disposal of another qualifying business asset. But there was also a situation where the asset in which you invested was said to be a depreciating asset, and that meant that the pure rollover as we knew it had to be adapted, that there was still a deferral, but we referred to it as a holdover rather than a rollover. Now again, if you've gone back and revised the rollover relief from chapter 14, then you're going to find this is a very, very easy chapter indeed. Because basically all we have to do in tagging on now to what we knew for individuals is, as you've seen throughout these last few chapters, indexation allowance. That's all we're doing. The same principles will hold true. It's just that in calculating the gain, once you've got the allowable cost, and rollover of course impacts upon the allowable cost, then getting that allowable cost, having got the allowable cost, we then apply the indexation factor to it. So all we're doing is just introducing a further reduction in our gain, the deduction as we know well now, indexation allowance. So let's remind ourselves therefore, if we need so to do, about what rollover relief is all about. As it says here in section 1.1, a gain may be rolled over. What does it mean? Deferred, where it arises on the disposal of. So we've got to be dealing with the disposal of a qualifying business asset and where the sales proceeds are reinvested in another qualifying business asset. What you will recall is that in this context, if you reinvest all of the sales proceeds in another suitably qualifying business asset, then the full gain will be available for rollover. It will be full rollover relief. If we fail to reinvest all of the proceeds and only reinvest some, then the best that we can hope for is what we knew as partial rollover relief. If, as we have said, the asset that we invest in is a depreciating asset, defined as one with a life of no more than 60 years, then we have to adapt the classic rollover into what we refer to as being a holdover relief claim. The immediate impact is the same. A gain arising now for corporate tax within the accounting period will be deferred, either in full or in part. The only question mark between rollover and holdover is when will that gain crystallise, and we'll be reminding you of that very soon. We refer, of course, to this relief as only being available on the disposal and then subsequent reinvestment in qualifying business assets. Now, although in real life the list of qualifying assets is indeed interesting and varied, we have but two assets or categories of asset that we need to know here. Same as we saw for individuals, and those assets, land and buildings, by far the most likely one, property there, where full rollover will be available if we're talking about reinvesting in a freehold property. As opposed to freehold, you might buy a leasehold property. Then, so long as that leasehold property has a life when acquired of more than 60 years, that means it's not depreciating and rollover relief is available. If, however, the lease that we acquire is of no more than 60 years, or that we reinvest in, the second category here, fixed plant and machinery, then what that will mean is what we can't do now is go into full rollover, but the deferral will still be available through holdover. More about reinvestment in depreciating assets just a little bit later. But firstly, your basic rollover relief. Now again, this should come as no surprise to you. It should be basic revision. What happens? The gain is not now immediately taxed, but it's postponed until, of course, the company makes a subsequent disposal of the replacement asset without then any further replacement. The beauty of rollover is that the deferral process may continue on ad infinitum, as the Latins used to say. It can carry on and on and on, because at any point at which there is a disposal, if there is then a acquisition and a reinvestment, if that reinvestment is at least in full there of all those proceeds, gain after gain continue to be deferred. So you buy a property, you sell that property. When you sell, you make a gain, but you buy another one, you roll over. You sell that one, you buy another one, you roll over. Those gains may continue to be deferred through rollover relief. So there's a deferral there that postpones the crystallization of the gain until we make a disposal without a suitable replacement. Now again, there may be a replacement, but if you fail to reinvest all the proceeds, then that will mean that some, if not all, of the gain will indeed then crystallize. It's called rollover because we roll over the gain made against the base cost of the newly acquired asset. What does rollover mean in that context? We reduce the base cost of the newly acquired asset. As we said here now in part C, if we manage to reinvest all of the proceeds, then all of the gain will be available for rollover. If we fail to reinvest any part of the proceeds, then that will give rise to some, if not all, of the gain remaining chargeable, but more of partial rollover later. There is a timescale within which the replacement asset must be bought. Now, I refer to it as a replacement asset because usually, of course, you're going from one property to another. In fact, for rollover to apply, all we've got to do is to dispose of a qualifying business asset and reinvest in any other category of qualifying business asset. But in terms of full rollover, it's only going to be land and buildings in terms of our syllabus. But the reality is, sell a qualifying business asset, reinvest proceeds in another qualifying business asset of whatever category, deferral will be available. As long as it's not a depreciating asset that you've invested in, it will be rollover that is available. If it's a depreciating asset, as we've said now 2 or 3 times, then it's still a deferral, but the manner of that deferral is different, and we've referred to that as holdover. The time scale for the reinvestment, we've got to buy the replacement asset, so-called, between 12 months before up to 3 years, some 36 months after the disposal date. So there's a 4-year window of opportunity in which the reinvestment of the proceeds must take place. Plenty of time, therefore, in which to be able to reinvest and go on then to make the claim. For the claim must then be made within 4 years from the end of the accounting period in which the disposal occurred. You have plenty of time in which to make your mind up about making this claim. Right, we've now got example 1 here for us to look at. Have a little read through. Again, the classics of rollover. You're looking to see here for companies, for corporate tax, what has been sold. Is it property used within the trade? If it is, and there is a subsequent reinvestment, then we're looking at rollover. If we reinvest all the proceeds, full rollover. If we reinvest some, but not all of the proceeds, then the best that we can hope for is partial rollover. So have a little read of the question there, and then we'll see about how we approach answering that problem. But hopefully you'll be way ahead of me by the time I talk to you again. So pause this for a moment, and then we'll start up again and go through it together. Okay, so let's see what we've got here therefore. JM Limited bought the building for use in the business in October 94. They tell us, of course, the RPI for purposes of computing the indexation factor and deducting then indexation allowance. The cost, $150,000. We then sold in October 2015, again RPI provided, for £400,000. So that will allow us to calculate the gain. We know the proceeds, we know the cost, we can work out the indexation factor and apply that to the allowable cost, thus getting the gain. Now, if nothing else happened, that gain would then be chargeable in the accounting period in which it arose. JM Limited has a 31st of December year end. The sale was in October 2015, so in the accounting year ended 31st of December 2015, we would be showing a chargeable gain based on proceeds 400,000 less cost 150 less indexation allowance based on that 150, and that gain would now crystallize. But of course what we then go on to see is that in December 2015, right, December 15, now we can see that we bought some land, so land and buildings, for use within the business, critically for £500,000. Now I say critically because it means we sold for 400, we bought for 500. What does that mean? It means full rollover relief is available to us. So I would in fact like you now to work an answer to this particular problem. You don't need me in fact to show you here. You know the proceeds, you know the cost, you can get the unindexed gain. Work out the indexation factor. We know the RPI now at point of disposal and what it was when acquired. Work out your 3 decimal place indexation factor. Apply to your allowable cost of £150,000 and establish therefore the chargeable gain. You then know that all of that chargeable gain may be deferred in a rollover relief claim. Why all of it? You of course put in your answer the fact that all of the proceeds have been reinvested. You also explain why in relation to the dates of the transactions that rollover relief is available in the first place. And that is that we can see that the reinvestment has occurred there within 3 years following the date of disposal. It could have been of course acquired prior to October 15 within the 12 months before. This property, this land, was bought in December 15. Well, that's right, so possibly by about 3 months at a maximum there, let alone 3 years from the disposal date, and hence rollover relief is available. And as we've said, available in full. Okay, now proceed please to calculate that gain and state that all of the gain is eligible for rollover. Having got that gain, what is the impact of rollover? You've got to here calculate the base cost of the new asset. Well, there's the actual cost, 500,000. It will be that minus the amount of chargeable gain that arose on that disposal. Nothing there, indeed, that you cannot handle. So work that through, check it out with the answer, and then join us again. Okay, well I hope now that having reviewed through the answer to that first example 1, that again you're fully aware about what the issues are in the context of rollover, at least full rollover. The only addition in terms of the exercise that we've had to do here as compared to back in chapter 14 for the unincorporated trader is again companies get indexation allowance based on the allowable cost. Alright, it will come as no surprise therefore when we look at the scenario now in example 2. So what are we told? Again, to compute the gain and the base cost then of the new asset. Again, going back to the original acquisition of some land for use within the business, May 03, obviously give us the RPI, and the cost 200,000. We then have the sale in October 2015. A Limited has a 31st of December year end, so yet again, the accounting year ended 31st of December 15 would be the period in which the disposal occurred and therefore the gain would arise. Again, they tell us the RPI for purposes of indexation, and then of course the sale proceeds. We sold for 350,000. But we're then told that a deferral will be available because in September 2015 there, now the land was sold in October and we had bought in September 15, i.e. within 12 months prior to the disposal date. Bought a factory for use in the business for £335,000. Now that again should tell you what this issue is. Sold for 350, bought for 335. What have we sold? What have we bought? Qualifying business assets for purposes of rollover relief. But because we have failed to reinvest all of those proceeds, some part of the gain arising will remain chargeable. Now that should not be a difficult calculation in terms of what remains chargeable. If you sold for $350 and you bought for $335, how much of the proceeds have you kept back? Have you failed to reinvest? $350 minus $335 is $15,000. So that amount, therefore, of that gain will remain chargeable this accounting period, and only the balance of the gain arising on the sale will be eligible for rollover. Let's see how, therefore, we put those numbers together. As we know, from the top, doing our basic calculation of the gain, what did we sell for? Our sale proceeds, £350,000. Deduct from that the allowable cost. What was the allowable cost? We're told $200,000. So we've got an unindexed gain, therefore, of £150,000, less indexation allowance. Now we know that the indexation allowance is based on our allowable cost. The allowable cost $200,000. And you, and notice I said you, not we, now have to work out the indexation factor. So get your calculators ready. There's the RPI for the month of disposal. Put that in your calculator, as well you know. Take away the RPI for the month of acquisition and divide that by the RPI for the month of acquisition. Round then to 3 decimal places and see what we get. We'll then multiply that out by, I hope you're doing it as I'm speaking here, 200,000. We will then deduct that indexation allowance to bring us down to, notwithstanding any other action that has occurred, what the chargeable gain on that disposal would amount to. Now the indexation factor that hopefully you have established here is 0.43. It is actually 0.43 because 0 was the 3rd decimal place. Multiply that through, that therefore, basically 2 times 43,000, 0.43 on 200 is £86,000. Take it away, leaving us therefore with a chargeable gain at this point of £64,000. But of course, given what we see has happened, some, not quite all, of the proceeds of $350 have been reinvested, there will be a basis for a rollover relief claim. We will have partial rollover. But the way that we calculate this is to actually work out how much of that gain will indeed remain chargeable and crystallise this period, and the rollover is then a balancing figure. We've already said how much of the gain will still be chargeable, because we know that having sold for $350, we've bought for only $335, and that therefore leaves £15,000 remaining chargeable. On that basis, what is the rollover relief? Well, of the $64,000 gain, $15,000 remains chargeable, so the difference, $49,000, is the extent of the rollover relief. What do we do with that rollover? Well, of course, the base cost now of the newly acquired asset will equal. It was actually $335 what we paid for it. Now the gain deferred, the rollover relief is 49 minus 49,000, and what will that equal therefore? I think that will come to 286,000. So the base cost of the new asset, 286 for purposes of a future disposal. One other statement to make: if you're dealing with a written exercise in section C and the question has asked for advice rather than just merely a calculation in respect of the disposal and acquisition of these assets, what we see here is that only 49,000, as we've got there, of the 64,000 gain was eligible for rollover at this point, leaving us with 15,000 still chargeable. Well, of course, the window of opportunity for rollover relief has not as yet closed. The disposal was in October 2015. Reinvestment of those proceeds of $350 may go on, and a rollover relief claim may then be made so long as reinvestment has occurred within 3 years of that disposal date. So although we have only at the moment reinvested 335, if a further £15,000 plus is invested in another qualifying business asset by or before October 2018, i.e. within 3 years of the disposal in October 15, then a further claim for rollover relief would be available to you. Now that, of course, further acquisition might be a year, 2 years, anything up to, but under 3 years from now. By that point, of course, we may well have paid, probably will have paid, the tax on the TTP, the taxable total profit of the company, for this accounting period. And that included that chargeable gain of 15. So if a subsequent rollover relief claim is made, that 15,000 is reduced from the TTP. We've already paid tax on the TTP. We'd have been paying tax at 20% on that £15,000 gain as part of the overall TTP, the taxable total profit, of course, there. 20% of 15,000 means we'd have paid, what, £3,000 of tax there on. If a subsequent rollover relief claim is made, then for this, the year ended 31st December 2015, we would now be able to make our further claim and reduce that tax by 3,000. Having already paid that tax, we would therefore get a repayment of the £3,000 overpaid corporate tax liability. So further hope for a further claim for rollover relief in the future should a further reinvestment of those proceeds effectively take place before the 3-year window of opportunity following the disposal date, i.e. by October 2018, before that runs out. Make the reinvestment, then we can make our rollover relief claim. Okay, so we've seen now, therefore, full rollover and partial rollover. Again, if you wish, just check with the numbers in the back in terms of making sure you're happy with how we've calculated the gain and, of course, with how we've computed the rollover and the effect of that rollover. Okay, so having dealt with full rollover and partial rollover, there is just one further area to deal with, and that, as we've already spoken of within this particular session together, is the fact that if you were to reinvest your proceeds, either in full or in part, in a depreciating asset, one with a life of no more than 60 years, then rollover, as we have seen it, would not be available. And instead, what I've referred to as holdover relief would apply. Now, when you look at answers produced by the ACCA and by the various approved authorised providers, they will still use the term rollover. I've simply tried to distinguish what we have done in terms of rollover and now holdover, because this time there is no deduction from the base cost of the newly acquired asset. Rollover, as we know it, means you roll over the gain on disposal against the base cost of the newly acquired asset. Rolling over against means deducting from that base cost of the newly acquired asset. Well, that, as we'll see, and I hope you remember from chapter 14, is not what happens here. Instead, that gain is deferred until the earlier of 3 events. We'll see if you remember what they are in a moment's time. First of all, of course, we need to recognise what are depreciating assets. As we've said, an asset with an expected life of a maximum 60 years. It says there all B, fixed plant and machinery. For the purposes of our syllabus, we will always assume that fixed plant and machinery has such a life, a maximum 60 years, which I think in reality is also true. The only other asset that we'd see, of course, made mention of here, fixed plant and machinery, and a leasehold property with a life of no more than 60 years. So either fixed plant and machinery or something like 55-year, 45-year lease, anything there that's not more than 60. That means, as we call it, not the rollover as we've seen, but holdover. What does it mean? We still get to deduct the gain, to defer that gain. And on the same basis, that if we reinvest all of the proceeds in a depreciating asset, then all of the gain will be deferred. If we reinvest some but not all of the proceeds, then it is partial deferral, only some of the gain will be deferred. But with the gain that you defer, what happens? Remember what we said? We do not deduct it. The gain deferred is not deducted from the cost of the new asset, this depreciating asset. Instead, it is deferred until the earliest of, well, one obvious one, the disposal of that new asset, be it the fixed plant and machinery, be it the short leasehold, shall we call it there, the leasehold property, no more than 60 years of lease left in it. Disposal. Or the cessation of the trading use of that asset. So if you stop using it in the trade, that would cause the deferred gain then to crystallise. Or if nothing else happens in terms of those first two to begin with, then there's a time limit, and that is 10 years after the new asset was acquired. If we still own it, haven't sold it, still use it in the trade, then at that point that deferred gain will crystallise. So here, with this type of relief, again what I'm calling holdover, you've got a time limit that applies. If nothing else has happened in terms of sale or cessation of trading use of that asset, then 10 years after acquisition, then the gain deferred will crystallise. Now, as we have said, if you have rollover, well, when you sell and buy, you roll over. The asset that you have now bought might be a freehold property that you keep for not just 10 years, 20, 30 years for use within the trade, and it's only on its subsequent disposal that the deferred gain would crystallise. Here, we've got a very set time limit. Right, example 3, calculate the chargeable gains as far as the above information allows for 2 accounting periods, year ended March 11, and then the one that obviously in an exam question we would be concerned with, and is the focus in fact of the attention of this problem, the year ended March 16. So what are we told? Let's analyse the information. We're dealing with our company YR Limited, and YR Limited has, well, we know a 31st of March year end there. Bought land for use in the business back in April 97. We're told the RPI cost 200,000. The land was sold for 350,000 in May 2010. In May 2010. May 2010 as a disposal date is within the year ended March 11. We're told again the RPIs, and therefore we can calculate the indexation. So there would be the first task to perform, calculating the gain that arose within the year ended March 11. How do we do it? Sales proceeds 350, cost 200, get the unindexed gain. Indexation factor, RPI then at the point of disposal minus RPI at point of acquisition, all over that RPI on acquisition. Get your 3 decimal place indexation factor, and as we always do, apply it to the allowable cost of £200,000. So job 1, what I want you to do therefore using that information is to establish that chargeable gain that arose on that first disposal, but also then give thought to, before we join up with the lecture again, to the fact that in March 2011 YR Limited bought fixed plant for use within the business costing £390,000. Remember, we had sold for 350, we are buying for 390, but it's fixed plant that is being acquired. So give some thought therefore as to what would happen there. Okay, let's see what we've got, and hopefully as regards the disposal there, back in the year ended 31st of March 11, we've got the basic gain computed. We know what we sold for, 350,000, we know the cost 200. Unindexed gain 150, work out the indexation factor. Again, we know the RPIs at the point of disposal and point of acquisition. Get your 3 decimal place indexation factor, apply it to the allowable cost. Hopefully, if I've done it correctly on my calculator anyway, those particular outcomes. That gives you the chargeable gain at that point. But of course what happened was in March 2011 the company bought fixed plant for use within the business. Now we know that fixed plant is a depreciating asset, but that will still allow a deferral to take place at that point, and of course a full deferral. For having sold for 350, we are then buying for 390. Again, therefore, reinvesting all of the proceeds. If we had bought for only, what was the sale, 350, if we had bought for £330,000, then we'd have taken £20,000 out. 20,000 of the gain here of 77,800 would have remained chargeable, and only the balance would be deferred. No such problem here. All of that £77,800 will be deferred. Now again, in terms of the language to use on your exam answer, if of course you're doing other than an objective testing question, then we can write in less rollover relief, although again I keep referring to it as holdover, purely in your minds to distinguish the type of deferral that this is. Because the deferral that we will now use will not roll over that gain of 77,800 against that base cost of 390. Instead, as we know, it will be deferred until the earlier of three events. Now, quite often what you see in an exam question is that this disposal, rather than happening way back in the year ended March 11, it's the disposal that would be occurring now. So what we would write about that chargeable gain is that as we have reinvested all the proceeds of 350 in a depreciating asset, the fixed plant, costing 390, the entire gain of 77,800 may be deferred, and it may be deferred until the earlier of. What would that be? The sale of that asset, the fixed plant, the cessation of the trading use of that asset, or maximum 10 years from the acquisition date there. Now, rather than getting that open-ended question, making the written statement, this is when the gain deferred would then crystallise, we're actually told sufficient information to allow us to work out when that £77,800 gain will crystallise. Because YR Limited went on to sell the plant in February 16. February 16 is in the year ended March 16. Therefore, what will then happen? Right. We had an acquisition date in relation to that fixed plant of March 2011. Remember the rule, the deferred gain, there is our deferred gain. That deferred gain will crystallise the earlier of. The disposal of the plant, that is happening in February 16, or 10 years from the acquisition date. March 11 would be March 21. We haven't yet got to March 21. No reference to the plant no longer being used within the trade. So February 16, that occurs within 10 years. That occurs within 10 years of the acquisition date. So it is that date that therefore is used as being the time when the deferred gain will crystallise. So in the year ended 31st of March 16, the deferred gain of 77,800 will then crystallise. Now, when you look at the answer, depending on which version of these notes you're looking at, whether you're doing it now to, well, I say now to September, or whether you're picking this up for December 16 or March 17 exams, the answer may say, when you look at it, that the disposal date, of course, there, February 16, is, of course, less than 10 years from the acquisition date, so it's the one to use. But they do say in the answer, in the first version of this anyway, that 10 years from the date of acquisition, and they reference March 2020. That, of course, should be March 2021. So if you have that original version of these notes, again, my apologies for another little updating error, something I missed when I went through there. It should have moved on to March 2021. It's irrelevant in the context of what you do as the final answer, because February 16, the disposal date, is well before that. It is that that causes the deferred gain to crystallise, and that will happen in the corporate tax comp for the year ended March 16. Okay, just before we finish on this, one final point just down at the bottom. When the replacement asset, it says here, is a depreciating asset, the gain is deferred, as we have just seen in the notes above. Now, we know that there's a maximum deferral period of 10 years. 10 years from the acquisition date of this depreciating asset. But we then say, however, if a non-depreciating asset were to be purchased before the deferred gain crystallizes, then the original gain may be rolled over against the cost of the new non-depreciating asset that is now acquired. And that means that that gain will then only crystallize on the sale of the non-depreciating asset. Not that it's likely that you'd have to deal with that, certainly not in computational, but maybe a discussion in narrative form in section C. But basically what we're saying is you might sell a freehold property and make a gain. You then reinvest the proceeds, let's assume all of them, in a depreciating asset, i.e. you buy a leasehold property where the life of the lease is not more than 60 years. So for example, a 55-year lease. But before that gain crystallizes, so got to be within 10 years of the acquisition date, but before that gain crystallizes, you buy another non-depreciating asset. Maybe, of course, there again a freehold property. So possibly we have originally sold a freehold, we buy a leasehold no more than 60 years, we hold over, we defer the gain. But before that gain then crystallizes, we buy another freehold. So what it means is that what was only originally held over may now be rolled over. And on that second freehold property, the one to be acquired there, then we reduce the base cost of that asset. What was held over can then be rolled over. So a bit more flexibility allowed to our taxpayers, be they personal or corporate. Right. Again, just note then again noted down here, time now to read a technical article or two, indeed on chargeable gains, parts 1 and 2. If you haven't already read it, now is the time for you to review through that. And it's a working exercise, as most of the technical articles written by the F6 examining team are. Do make sure that as they go through examples in those notes that you work them. Don't just read it, not just, oh yeah, that looks okay, in one eye, out the other. You work those examples as well, and in that way you'll become stronger. Remember, whatever the examiner has said, this is what you need to know, then you really need to know it. So you make sure that every one of the technical articles written that you have thoroughly worked through prior to you going on and using your exam kit, or if you are fortunate enough to do so, to go on to a revision course at some local provider for you. But do make sure you've worked those technical articles. Once done, you can then attempt practice question 28. Now, that sorts out for us our rules in terms of capital gains for corporate tax. It means that when we meet next, we'll be going on to look at the last of the corporation tax chapters that we have to deal with, and it will bring in the concept of groups. So rather than just dealing with a single company, we'll be dealing with a group of companies. We'll have to define what we mean in terms of different types of groups. All of that awaits us in our next and indeed final session in relation to corporate tax computations and the preparation thereof. There will be one other issue that will be important to us, and that is about the timing of when we pay our tax. So what we'll do at the beginning of the next session is to have a little look at our normal due date for when companies pay corporate tax, and then what is referred to back in our introductory chapter. I think that was chapter 16, Introduction to Corporate Tax. If you go back and have a little look at that, I made a reference to quarterly instalment payments and when they would be due. And they are due a lot sooner than indeed the normal due payment would fall due. But at the beginning of the next chapter, though it will be based on groups, for us to understand some of the most important groups issues, we need to know a little bit more about quarterly instalment payments and the comparison with the normal due date. So when we start up next time, we'll actually be having a look at the administration chapter in terms of corporate tax, before then referring back to the groups chapter. So we'll begin by looking at a little bit at the start of chapter 23. That will allow us then to better understand, at least I hope to better understand, some of the principles that we refer to in this chapter 22. Okay, we look forward therefore to meeting again in our next chapter together.